Now, commenting on this ratio here, this is what you need to follow in order to comment on these ratios. So when we comment on return on capital employed, we look at the following. As always, you always take this year's return on working capital and you compare it to last year's, and you have to comment whether about whether there was an increase or whether there was a decrease. If there was an increase, you have to specify what resulted in the increase. If there was a decrease, you need to specify what resulted in the decrease and what could be done to make it better. So you have to come up with a solution. Just remember to always be brief and do not waffle. Okay, be brief, get straight to the point. Okay. Return on capital employed should always be higher than the interest rate on borrowed money. So your return on capital employed must be higher than interest on loan. It must always be higher than interest on loan. If it's lower than interest on loan, and then that will be problems for the business because it simply means that the business is just operating in order to repay its debt, and therefore it's not employing its capital efficiently so that the owners or equity holders can also get some return from the business's operations. As I've said, it means that let's say our interest on loan is 10%, but return on capital employed is only 9%. It means that the capital employed doesn't even result in returns that can enable us to repay the people that contributed that capital into the business. And remember, the first people to be repaid will be the lenders. So now, if our return on capital is 9%, it means we can't even repay the lenders the full 10%, which we need to pay them. So we even owe them 1%, which could result in serious financial implications for the business. Okay. If it doesn't exceed interest on loan, as I have said, it will simply result in us getting more loan and therefore decrease. It will result in a decrease of shareholders' earnings. Okay. If a company has a low return on capital employed, it means that it is using its resources inefficiently. That's why you need to investigate management's actions as they might be involved in. Remember, when you are a director of the company, you need to act in the best interest of the company. And if you don't act in the best interest of the company, then you must just go, right? And your main responsibility as a shareholder is to generate profits, make sure that the company is in a stable financial position and it's generating enough revenue to pay the lenders and to pay equity participants. And if it fails to do that, then it means that management must go. And in most cases, especially with respect to companies, state-owned companies, the biggest problem that is facing operations in state-owned companies is the fact that the resources are not employed efficiently. Money that was meant to buy assets end up buying things for there's corruption for politicians and anyone who's linked, and some of the directors that are employed to run these state-owned companies run them in order to benefit themselves. And I don't want to just limit it to state-owned companies. There are a lot of companies as well that were found wanting that. That is because their directors employed capital inefficiently. efficiently, just like I've told you about Steinhoff Veritas. There's more actually, and you realize that in all of this, external auditors were implicated. We're talking about Deloitte, KPMG, and some PwC partners were also involved in the whole thing. Okay. Then we've got net asset value per share. This is the value of the company. Net asset value determines the true value of the company. The true value of the company, guys, remains in net assets. Net assets is simply your shareholders' equity. So you're going to look at the shareholders' equity and divide it by the number of shares issued, not authorized, but issued. So it's your net assets, which is your shareholders' equity. Please note that net asset represents your shareholders' equity. Let me just show you what do I mean by that. We did this, guys, from grade 9, and well, with you guys, I did it from grade 10. And I always say to people, accounting is pretty much all about this. It's all about your assets being equal to your owner's equity plus your liabilities. These ones, guys, please note that are simply what the business owes. And on the left-hand side, it's what the business owes. All right. Now, the business normally owes two people. It owes equity holders, who are the shareholders. It also owes the lenders, who are the lenders to the business. Okay. Liabilities, who are the lenders to the business. Now, the net asset value of the business, it's simply your owner's equity. That is because net asset value, it's simply your assets minus your liabilities. Assets minus your liabilities will give you your net assets, provided that your assets are greater than your liabilities. If your liabilities are greater than your assets, then that is a different scenario which affects your solvency and your operation as a whole. So basically, owner's equity is simply your net assets. So for you to find net assets value, you will simply take your owner's equity, you divide it by number of shares, not authorized, but number of shares that have been issued. That is the true value of the business, beside the one that is determined by Johannesburg Securities Exchange. Okay, the net asset value per share indicates the value per share of a company. It indicates the value per share of a company. As I have said, it determines the true value of the business. The true value of the business. Why did you open up a business in the first place? That is to create wealth or value for yourself. Now, what is the wealth of the business? The wealth of the business is determined by taking your total assets minus your total liabilities. No, that means that no one, whatever is left means that no one has claims over it. So it is 100% what belongs to the company. Your net asset value per share will be equal to your shareholders' equity. You divide it by the number of shares that have been issued. Net asset value is your shareholders' equity divided by the number of shares that have been issued. Guys, once you understand what you're doing, this will be totally easy for you. Whatever you get, you multiply by 100 and you represent it as cents. All right, you write it as cents. Now, how do we comment on the net asset value per share? You look at the following, as I've said, compare this year to last year, figure out whether it increased or decreased, and then you have to compare to market prices. In most cases, guys, your net asset value per share will be lower than what the Johannesburg Stock Exchange values the company, because Johannesburg Stock Exchange is based on recent movements in shares, and it's determined by demand. As to remember, the higher the price, the higher the demand. If your companies' shares are in demand, the value of those shares will go up. Whilst net asset value is determined, it's based mostly on historical values, all right? And doesn't take inflation into account as I've specified. Market prices will normally be higher than the net asset value per share. That is because asset values are usually understated, which means net asset value will be lower. Supply and demand forces in the market generally push stock prices above book value. So if your company's prices are not above your net asset value, so according to the market, that is, if the value determined by JSC, the value of your company is determined by JSC, is not above your net asset value, you should be concerned as a business because demand and supply usually pushes your share price above your net asset value per share. If the net asset value is much lower than the market value, the financial markets are probably experiencing a bull market. A bull market simply means that financial markets are doing very, very well. Okay, the economy is doing well. Basically, most companies in South Africa are generating enough profits or revenue, that is. Okay, bull market simply means markets are good, and a bear market means that financial markets are just crashing. They're not making enough returns. They're not making enough value. And that's the situation that is facing South Africa at the moment. Okay, that's what net asset value per share is. We've got earnings per share. Earnings per share, it indicates a company's profitability. Earnings per share show how much the profit of the company have been made per share. Earnings per share, as it's specified, you just take your net profit, you divide it by the number of shares issued. Please make sure that whatever you take as your net profit must be after tax. Earnings can only be determined by the final profit, which is after tax. Once you have paid your lenders and once you have paid SARS, because SARS, guys, you cannot make a mistake of not paying SARS, okay? You divide it by the number of shares issued. Please, guys, when you write this formula down, remember to highlight number of shares issued, not authorized, issued, all right, at the end of the year. You need to divide by the number of shares issued as at the end of the financial year. You multiply that by 100, earnings per share will be written in cents. Okay, how do we comment on this? We comment, you will look at, as I've said, compare this year to previous year, comment where there was an increase or decrease. Look at the profitability of a company, as this will affect earnings per share. So if the company's profits are down, earnings per share will be down, which makes sense, guys, because if your numerator is small and your denominator remains constant, it means that your net profit is determined more by your income being more than your expenses. So for you to increase this ratio, you need to make sure that your income is more than your expenses, all right? So if your income is more than your expenses, that is profit. So your profits have to be higher for earnings per share to be higher, provided that no new shares were issued. If new shares are issued, it means the denominator will be higher, resulting in earnings per share being smaller. Please rewatch the previous video because I explain how the increase of your denominator will decrease your fraction. Okay, please guys note this you have done the maths. The higher the denominator, the lower the whole fraction. Okay, so for the fraction to get bigger, your numerator must increase at the rate that is higher than your denominator. Okay, the higher the denominator, the lower the fraction. So in this case, you don't want your number of shares to always increase as they will decrease earnings per share. It means that you guys there will be a lot of people that have a share over profit, resulting in each shareholder getting a smaller and smaller return. That's why most businesses are reluctant to issue shares using equity, raising capital using equity, because when you raise capital using equity, it means that a lot of people will have a share over this pizza, which we refer to as profit. Pizza being profit. The more you are, the more people or friends you have. When you buy pizza, it means that each of those people would get smaller pieces, okay? But if the pizza is they're still the same, but there are few people, it means that you will get a bigger piece of the pie or a bigger piece of the pizza, right? And then dividends per share, these are simply returns to the shareholders. This is why shareholders will normally buy shares in order to get dividends. So we are trying to determine per share, how much are you going to get as dividends per share, all right? Now, dividends per share, it's your ordinary share, your ordinary dividends. It's dividends on ordinary shares. Okay, it's dividends on ordinary shares divided by the number of shares issued. Remember, dividends on ordinary shares, it's simply your interim dividends plus your final dividends. It is simply your interim dividends plus your final dividends, meaning that, guys, your numerator will simply be your interim dividends plus your final dividend. The numerator will be the interim dividends plus your final dividends. So this over here will be interim. Okay, I wonder what's happening with my pen there. Um, okay, my pen is just not working with me. So just remember that your dividends paid are your interim and declared will be your final. So your interim dividends plus your final dividends, you add them together, you divide it by the number of shares issued to get your dividends per share. All right. You compare to the previous year. When you comment, you specify whether there was an increase or a decrease, and an increase in dividends per share is usually a sign, as it shows a positive sign, as it shows the directors of the company that the growth can be sustained. Okay, so a lot of businesses, even though they don't have cash, they will declare dividends just to make sure that the share price is increased, because when your dividends increase, it indicates two things. It indicates that the company has money. So there is cash flow. Without cash flow, you cannot declare or pay dividends. Okay. And secondly, it indicates to the market or people that will invest in the company that there is value in that company, and the value in that company can be sustained. Growth in that company can be sustained. So that is why, guys, it's very important that you maintain a positive dividends per share. Now, as I told you previously that Discount did not declare dividends in the previous financial year. So that simply says that we have cash flow problems at Discount. And it's not just Discount. There are a couple of companies that did not declare dividends, and that is because they didn't have enough cash. Okay, for you to declare dividends, guys, you have to have enough cash, because immediately when you declare dividends, you will actually I'm looking for the right word. You will actually write that declaration as a current liability. A current liability is a liability that must be repaid within 12 months. Immediately when you declare knowing that within the next 12 months, you're going to have money to pay those dividends. If you don't have money to pay the dividends, then don't declare. Okay, interim dividends are declared and paid. Remember that. A decrease in dividends per share can indicate to investors that the company is not doing well financially, and it could lead to a drop in the market value as investors might sell off their shares. Guys, remember, as you are the investor, you are looking at dividends. So if the company cannot give you dividends, what's the point of investing in that company? You might as well jump the ship and buy shares in a company that will give you a return. Because remember, guys, as an investor, your primary goal is to generate a return. If your investment doesn't generate a return for you, then you need to jump the ship. All right. Earnings per share can also be compared to dividends per share in order to determine the percentage of earnings that were distributed to shareholders. Okay, so basically in this case, simply means that your earnings per share must be greater than dividends per share, because imagine dividends per share is 5 rand and earnings per share is 4 rand. It means that you cannot generate enough money to pay for dividends. So you are simply, it means that either 1 rand must come from retained income, which are profits that were not used in the previous years. Okay. Now let us look at the summary of everything. And I just need you guys to pay attention to the formulas that we will be doing here. Percentage on gross profit. It's simply your gross profit divided by cost of sales, you multiply by 100. Okay. Gross profit on sales is simply your gross profit divided by sales. Gross profit on cost of sales is gross profit divided by cost of sales. Gross profit on sales is gross profit divided by sales. Now the percentage is compared to the previous year as you comment. It is also compared to other companies in similar industries. Okay, so it shows how well a company controls the cost of its inventory. If it is below the expected profit margin, it could be due to the following. We offered too many discounts. Prices were calculated or recorded incorrectly. In that case, guys, that's a mistake you cannot afford to make. There's a strong competition and push the selling price down. And now there, guys, it's you need to know in different industries which companies are competing. Like in pharmaceutical industry, you know that this game is a tough competitor of clicks. All right. So if there's a strong competition between the two, their gross profit on sales and gross profit on cost of sales will drop. Okay, suppliers' prices increased. In the recent years, guys, you realize that suppliers' prices have increased. Fuel prices went up. So if fuel goes up, guys, it will increase cost of sales. It will increase cost of products, which increases cost of sales. The higher the cost of sales, the lower the gross profit. You need to remember that gross profit is simply sales minus cost of sales. Gross profit is sales minus cost of sales. Gross profit is sales minus cost of sales. So as I've said, okay, it's just refusing to work with me. Now we're going to look at margin ratios. Margin ratios, we've got operating profit on sales. It's simply operating profit you divide it by sales. Okay, that's all. That's what your margin ratios. We're gonna do a lot of them as a matter of fact. So operating profit on sales. You want your operating profit on sales. For this ratio to be higher, your operating profit must be a little bit higher. Please remember, operating profit is simply your gross profit plus your other income, and then you minus all your expenses, then you will get your operating profit. Okay, it's your gross profit plus other income minus all your expenses. This is what your operating profit ratio will be. You multiply that by 100, you write it as a percentage. As I've said, note that your operating profit, it's simply your earnings before interest and tax. Okay, it's earnings before interest and tax. So when you look at the financial statements, as I've said, please note that your operating profit will be your gross profit. Operating profit will be your gross profit plus your other income you minus your operating expenses. That's what it is. Okay. So in the income statement, remember you're gonna have sales minus cost of sales, you get gross profit, you take gross profit, you add it with other income. Under other income is the sum of your rent income, commission income, provision for bad debts, if it was well, if your provision that you had in the trial balance was lower than the one that you actually was higher than the one that you calculated. So it results in income, that income, all of those that fall under other income. And then you take that, it will give you your operating income. And then from your operating income, you minus your other expenses. Under other expenses, it's your audit fees, director's fees, depreciation, blah, 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 blah. And then whatever you're left with after subtracting all of those, it will be your operating profit. So for you to figure out how much you've made profit-wise, now this is before you pay two important people. This is before you pay your lenders and before you pay SARS. Remember, guys, that is very important. Before the profit, before you pay your lenders, and before you pay you pay SARS. In essence, guys, your operating profit percentage must be higher than interest on loan. When you think about it, it must be higher interest on loan. And it also must be higher than your tax rate. Because if it's not higher than your tax rate, it simply means that you might not be able to pay those people. Okay. And remember that, guys, this is just on sales, on sales. So if you don't generate enough percentage that is not higher than your interest on loan, that is not higher than your tax rate, then how are you going to pay SARS and how are you going to pay um, your lenders? Now, understand that it's very important for your sales, while your profit on sales. Remember, profit on sales simply says that your sales can enough to cover all your expenses. Now, if they're not enough to cover your interest on loan and SARS, then you're in trouble. It means there will also not be enough to cover earnings, which must be paid to equity participants. Okay, now, this measures the overall operating efficiency, whether you are generating enough sales that covers all your expenses. It tests the business's cost control, its control over operating expenses. Remember, you don't want your operating expenses to be out of hand. And at the moment, there are arguments, especially in the corporate world, that salaries and wages constitute a higher amount of your expenses. So basically, labor is too expensive in South Africa. And you realize at the moment there was a big war. Well, it's not a war actually. It's something that I consider to be, I don't know how we can justify that, where the CEO of Sibande, I don't remember if Sibande still Waters, um, was given a bonus of around 300 million rand, while else the workers were asking for 1,000 rand salary increase. Now that shows you how biased South African economy is. I mean, so it's too expensive to share 300 million amongst workers. I mean, I'm sure that the CEO already earns a higher salary and to be given, I know that it's their company, they run the company, it's operating because of them, but does that justify, why is morality in all of that? And does it, we'll talk about um, King Code later on. Are profits really what investors should be happy about? What about the community? Is it justified? It's a capitalist country, I guess, but is it justified to give a CEO 300 million rand, yet refuse to give workers 1,000 rand salary increase? Hmm? Well, that's a debate for another day. Okay. It will be compared to previous year's figures, and the decrease in this percentage indicates the business was less efficient in controlling expenses. So this is all about controlling your expenses as the business. Okay, net profit on sales is simply your net profit after tax, so after everyone has been paid. So guys, if your net profit after tax is small, it means that your sales are not generating enough money so that you can have enough money that you can pay to your equity holders. That's what it is, meaning that if this rate is not high enough, your earnings per share might be lower. It means your sales do not generate enough money for you to. So this simply is your share of your sales, Vila. Okay. So if your share of sales, Vila, your sales are not generating enough money to have something left, it means you won't have anything left to declare your dividends because your dividends are declared out of your net profit. Okay. This is after SARS has been paid and your lenders have been paid. Comparing this figure to percentage of operating profit on sales will show the effect of finance costs had on the business. So if this figure is way lower than your operating profit, it means that the business is indebted. You get it. The business is in debt. But also it simply indicates that the business did not generate enough profits, meaning that it didn't control its expenses efficiently. But a huge drop between your operating profit and your net profit after tax, we can actually say that it's because of your interest expense. If a huge drop, it's because of interest expense. Because after operating profit, the only biggest thing you can subtract is your interest expense. All right, so if there's a huge drop, it means that your interest expense is too high, meaning that you are highly indebted as a business. Guys, to figure out whether you've been highly indebted as a business, you don't need to look at the balance sheet, okay? Your income statement can tell you if your interest expense is high, then you can tell that we are indebted as a business. And if your interest and expense is high, compare your operating profit on sales percentage with your net profit on sales percentage, okay? E.g., a percentage of 7% indicates that every 1 rand in sales, 7% is profit. A decrease in this percentage indicates that the business was less efficient in controlling expenses. More than anything, it was careless in taking more credit. And then you've got operating expenses on sales, which is your turnover. I don't know why we're repeating that because we actually did that above. Those are your margin ratios. Then we've got liquidity ratio. Liquidity refers to the business's ability to settle its short-term obligations, which is debt, okay? Such as bank overdraft, creditors, and short-term loans. How well did the business manage its working capital? Please note that working capital is simply your current assets minus your current liabilities. So you need to make sure that your current assets, your positive working capital indicates that your current assets are more than your current liabilities. So if your current liabilities are more than your current assets, you have a negative working capital. So you don't really have money to settle your short-term obligations, which is a risk. Okay, if you don't have money to settle short-term obligations, what are the chances that you have enough money to settle long-term obligations? Okay, the first one will be a current ratio is to current liabilities. Okay, and then we've got asset test ratio. Asset test ratio is the same as the current ratio, except that from your current asset you minus inventory, which is your trading stock. Or you can simply put it as that. Okay, please note inventory, it's simply your trading inventory plus consumable stores on hand. Both these ratios, they simply tell you whether you have enough current assets to cover your current liabilities. Do you have enough current assets that can be converted into cash in within 12 months so that you can pay your lenders, your short-term debts, that is. A good indication of the current ratio is that there should be at least 2 current assets for every 1 current liabilities. Well, this is a little bit questionable, okay? All I can say is that you need to make sure that your current assets are more than your current liabilities. That's all that matters. It doesn't have to be twice, but it needs to be greater than your current liabilities. You need to be able to settle. So it must be greater. It must be greater than if your current liabilities is 1, it must be 1.5. Okay, the current asset must be 1.5. And we'll talk about this. Asset test ratio tells the ability of the business to settle current debts under abnormal circumstances, such as during bad economic climate, just like under COVID. A lot of businesses went down. That is because a lot of businesses relied on trading stock to pay their lenders. And without trading stock, without them trading, they couldn't pay their lenders. That's why it's important as a business to diversify, to not put all eggs in one basket. As much as you're running a restaurant, take the profits that you're making from that restaurant, buy something else. Probably just like do what McD is doing. In case you haven't realized, McD is simply not renting its shops. Wherever McD is, they don't rent. They simply buy and then build their own. So that is creating wealth. You know that even when things go bad, you can simply sell that shop or simply rent it out and generate passive income. Again, there is a norm, and I don't like the norms, but you need to make sure that your asset test ratio, for you to say that you're healthy, it means that your current assets must be more than your current liabilities. So if your current liabilities are 1, it means that your current asset must be 1 point something, or 1:1 will be better. All right. A possible way to improve the asset test ratio is to sell off excess stock and to collect debt sooner. One way, guys, if let's say your current ratio is 5:1, and then your asset test ratio is 0.5:1, that means you are holding too much stock. And if you're holding too much stock, then it means you're not selling. Okay. And if you're not selling, there won't be enough sales, there won't be enough operating profit percentages. Okay, so that will be a concern, all right? For you to have a high current ratio, but your asset test is low, it means you're keeping too much stock, and too much stock could cause problems because of technological problems, trends, or they might go obsolete, and that will create problems for the business. Okay, this ratio should also not be too high, as it indicates that excess funds are tied up in current assets which are not earning a return for the business. Though that, guys, current assets do not earn a return for the business. Okay, now this is what I say it's a good way of running your business. You sell goods on credit, okay? So that's why there's credit sales, because people want to get rid of stock. You come up with a good credit policy to collect that money from debtors as soon as possible. After getting that money from debtors, you buy more trading stock and then you sell more trading stock. So you need to make sure that your credit payment period is longer. You do not rush to pay your current liabilities. Okay, you do not rush. You take your current assets and try by all means to convert them into cash as soon as possible. And when you convert them into cash, reinvest them into current assets again, convert them into cash. So you take the return from your current asset, you reinvest it to make a higher return. Once you have a higher return, then you take the higher return, you pay your creditors. Instead of taking more current liabilities, you take whatever you had remained, you reinvest it, you buy your current assets, your trading stock, and then you generate more money. If you operate like that, and your business operates for a longer period, you might end up not having too many debts. So you might end up with a ratio of around 10:1, meaning that your current assets are more than your current liabilities by a huge margin. But you need to pay attention to the fact that you do not want your liabilities to be too high. You do not want your liabilities to be too high. Okay. Net working capital, as I've indicated, it's simply your current assets minus your current liabilities. A positive net working capital means your current assets are more than your current liabilities. Efficiency ratios, we've got stock turnover rate. Stock turnover rate represents how fast can you convert your stock into cash. That's what it's all about. So for your stock turnover rate, you take your average trading stock. Your average trading stock is your trading stock from last year plus trading stock for this year, divided by 2, and then you will get your stock turnover rate. Stock holding period refers to how long you are holding stock, all right? Now you realize that stock turnover rate and stock holding period will go in handy. For businesses like your ShopRite, Pick and Pay, your turnover rate will be a little bit high. Your holding period will be a little bit short. I think stock holding period for ShopRite. Um, I forgot it. I forgot it. I forgot it. I'll look at the financial statement, but it will be small because ShopRite sells a lot of items on a daily basis. And I've been observing a lot of ShopRite shops, and there's always a delivery truck every week. So I don't think they're holding too much stock. I think they're selling a lot of stock. So their holding period is a little bit short, and their turnover rate is high because they sell for cash. So turnover rate is a little bit high. Turnover rate refers to how often you convert your stock into cash. Okay, the number of days or months stock on hand will vary from one business to the next. For instance, if you're selling cars, the stock turnover rate in a year, guys, will be way small because you sell one car probably after 3 months or so, or even a year. All right. So it depends on the type of business and the type of product. So we can say for non-current assets, stock turnover rate is small. For your current asset, when you sell your inventory, your trading stock turnover rate will be a little bit small. I think for clicks is 66%, if I'm not mistaken. Oh, I stand to be corrected on that. Okay. Your aim, guys, is to increase your stock turnover rate and to reduce your stock holding period because, guys, stock holding period, well, when you hold too much stock, as I've said, it means your money is tied up in your stock, and that money could be used for other things. So you don't want too much money to be tied up in your stock. And if it's tied up in the stock, guys, I understand when you bought trading stock and it's sitting there in the warehouse, it means that your money is in the warehouse and it's not working for you. I hope you understand. So you don't want your holding period to be long. All right. But at the same time, guys, we call it optimum stock holding period. You don't want to be found wanting where you have sold a lot of stock, but you run out of stock. Know that when you run out of stock, you're chasing customers away. So you need to find an optimal level which is good for you to hold enough stock to sell, but you don't want to hold too much stock because holding too much stock results in stock holding costs. And stock holding costs, guys, it's things like security, and more stock we hold, it will be stolen. So there's a high risk that it will be stolen. So there's a high risk of theft when you're holding too much stock. Or let's say like in South Africa where people decide that when you're not happy, you're gonna ban the stock and you're holding too much stock, guys. When they ban that stock, you're losing a lot of money. And I know a lot of businesses struggled during COVID period because some of the stock, I know that some of the stock that you insured, a lot of stock is insured. But when you claim insurance on that stock, guys, it's a problem. Okay, they might not give you 100% of stock that you have lost. They might give you 80%, meaning that the 20% is the loss. You remember this, guys, when we did income statement, loss due to theft, loss due to fire, where you claim cost of stock that you have lost, but you don't get what you have claimed. So the one that you don't claim, guys, it goes under expenses, resulting in less operating profit, less net profit on sales, less net profit on sales, less earnings per share, less dividends, because there's nothing to really get. You understand the ripple effect of what could go wrong when you hold too much stock. But at the same time, you don't want to be found wanting when I know that at the beginning of COVID, a lot of pharmacies didn't have enough vaccines, right? But now they have a lot of vaccines. People are not vaccinating, and now they don't know what to do with those vaccines. And it's a loss. It's just a loss to them because most vaccines are expiring. And that's what's facing this camp. That's what's facing clicks. On the other hand, the stores were vandalized during looting. So I don't know if pharmaceutical companies are doing that well. I know that even Aspen is considering shutting down their plant that they opened in order to manufacture vaccines, because even African countries are not buying vaccines. So there is, what's the point of keeping it open? And they wanted to keep it open so that it can be cheaper to manufacture vaccines. But now people are not vaccinating and the numbers are going up. It's a tricky situation. All right, we've got average debtors collection period. Average debtors collection period, you simply take the average debtors, you divide it by your credit sales. So you need credit sales for you to calculate average debtors period. You want this to be within 30 days so that you can collect a lot of money in a short period of time that you can use to pay your creditors payment. So creditors payment period must be a little bit longer. So when you negotiate with your creditors, negotiate for a longer period. And when you come up with credit policies, credit sales policies. Make sure that credit sales policies are not beyond your creditor's payment period. Okay. Now, businesses should negotiate longer. Oh, it's already here. Okay. Wow. However, the business should make sure it pays its creditors on time to prevent being charged interest. So you need to collect a lot of money from your debtors. I will ask my debtors to pay me within 30 days. Okay, now imagine I collect that money within 30 days. It means I can go and buy another stock and sell, and then encourage sell for cash and on credit, and then encourage the credit sales to pay within 30 days again, and then take that money, buy stock, sell cash or credit. So are you aware that if I negotiated to pay my creditors within 90 days, or I negotiated for 90 days, it means that within 3 months, I would have made more money from what they gave me. I would have made 3 times what they gave me. And I'm just giving them what uh, what I used in the first 3 months, in the first month. Okay. So meaning that I've generated so much money that to the extent that it will reduce my chances of going back and buying more on credit. Okay. Which is why I think Warren and Elon are basing their investment decisions on that. You know what? If you cannot generate enough money with what you have, you tend to rely more on debt. Then why must I invest in you? Get it? You cannot generate enough money to keep yourself afloat. You rely on other people's money to keep yourself afloat. So what are the chances that you will survive for a long period of time? Which is what banks faced in 2008 financial meltdown. Okay, it's a very interesting scenario. Bond markets and securities exchange markets. Okay, let me not go there because it's a little bit tricky for your level, but you will learn more about it as you go. All right. Solvency, guys. Solvency is one of the most important ratios. It's where you compare your assets to your total assets, total liabilities. You want your liabilities to be higher than your assets. So this ratio indicates whether you are capable or able to settle all your obligations as the business. Okay. It also indicates the amount of assets that are financed through debt. This ratio should be at least 1:1. I don't like this 1:1 thing on norms. Guys, all I can say is that you need to make sure that it's your, if you have one as your liabilities, your assets must be at least 1.2, 1.3. So they must always be greater than your liabilities. Fight for your assets to be greater than your liabilities, because if your assets are lower than your liabilities, that is, guys, if this ratio doesn't reflect a positive financial situations for the business, you might actually go insolvent. So this ratio is very important. If let's say your liabilities are 1, okay, let's say your liabilities are 1, liabilities are 1, and your assets, let's say it's 0.9. Guys, this is a problem because it means that liabilities have claims over your assets, but those claims over assets are not even enough to settle the liabilities. So this represents a serious financial problem for the business. So this solvency ratio, guys, it indicates whether you must go down or simply decide to sell your assets before until they are taken on auction, because when they're auctioned, they will be sold at a lower price. So this is very, very important. You don't have to meet that 2:1. You just need to make sure that you can settle your liabilities, right? And then we got debt to equity. We spoke about this. I will not get into this. The returns, we spoke about a lot of these as well. That spoke about that. These are market ratios. Market ratios, we've got net asset value per share, dividends per share, and earnings per share. So when they ask you to calculate market values, these are the ones that you have to calculate. When they ask you to calculate liquidity ratios, we're talking about current ratio, assets ratio, debtors collection schedule, we're talking about creditors payment period, we're talking about stock turnover rate. Okay, all of those will fall under liquidity ratios. These are market ratios. So it simply tells you, based on market, is your business doing well or not? Okay. That's it from me explaining these ratios. During our lesson, we will simply be calculating them. All right. I'm going to start with liquidity ratios, go into market ratios as well as return ratios. Profitability ratios, I'll do them right at the end because those ones are quite easy. All right. All I can say is, Hotzon, please make sure you watch this video before attending the lesson.